Hello everyone, thank you for being here. We're excited to introduce you to some local investors and get your questions answered. Excited to have some student MCs who are going to lead the conversation, and thank you, of course, to our panelists for being here. We appreciate each of you taking the time to introduce students and answer their questions. Okay, I'll let you guys take it.
Hello, is this working?
I think check to see if it's on.
Just put it close to your mouth, Min.
Hello?
Yeah. there you
Yes.
go.
Hello, my name is Linnea Nguyen. I'm a junior economics major, entrepreneurship minor here at Trinity. I've been involved in different things, including a summer team with Jalen Dynamic Crowd and some of the new finance programs like the Student Managed Early Venture Fund and the Alamo Angels Fellowship Program.
All right. I'm Benjamin, and I'm a junior finance and economics double major. Prior to this, I was with a venture capital fund backed by the Malaysian Ministry of Finance for about half a year. And I'm currently a part-time investment analyst with Miracle Plus, the largest startup accelerator in Asia, which was founded by Sam Altman, the CEO of OpenAI. Yeah, so with that said, I'll let our panelists introduce themselves.
Well, hello everyone. Thank you for coming. My name is Jose Padilla. I'm an attorney. I have my own law firm here in San Antonio. I focus on venture capital law. Basically, my clients include investment funds, angel investors, as well as startups and entrepreneurs. I do kind of everything from corporate formation to their financing, whether preferred stock financings or convertible notes, daily contracts, as well as mergers and acquisitions. And my clients are all over the U.S. and international. And I've been angel investing for about 3 or 4 years now, in addition to my day job as an attorney.
Hi, thanks for having me. My name's Lara August. I'm the founder and CEO of a company here in town called Robot Creative. We do marketing and branding, mostly working with established, very large small businesses. About 15 years ago, I started mentoring through a couple of different incubator and technology programs. I'm a mentor here through the Trinity program. I mentor for Techstars up in Austin, and began angel investing around that same time. So about 12 years ago, I made my first couple of investments, and then really have been doing it much more in force for like the past 7 years. And excited to be here and answer questions.
Hi, my name is Amit Mehta. I have sort of 3 day jobs. I'm a GP in a venture fund out of Silicon Valley, about $1 billion under management, and I run the healthcare vertical, which is the second part of my day job. Is I'm a physician, so I'm a radiologist, and we have a large practice here in town called Strick. And then I was an entrepreneur for about 8 or 9 years and sold a company last year, and got out of the entrepreneurship game. Locally, I've been angel investing for about 20 years, and I'm the founder and on the board of the Alamo Angels here locally, where some of these folks have worked, and we're busy still growing that. So anyone who has interest in angel investing, I would strongly recommend you come to those events, or at least try to get involved. There's lots of opportunity in that organization as it grows, and has come under the umbrella of Velocity Texas, which is also a large entrepreneurship in the biotech sector organization here, if you haven't heard about it. But we're always looking for folks who have interest in angel investing and working with us. So anyone has interest, feel free to talk to me or just look us up on the website.
Thank you for the instructions. For our first question, the average age for a venture-backed unicorn founder is 34 as of when they found the company. Considering our audience is primarily students, what can they do to be taken seriously in this space?
So most of the angel investors that I know don't talk too much about unicorns, or don't, we'll talk about them, but I don't think anybody has that expectation when they're looking at a student. We're not thinking, oh, this is going to be the next unicorn. So there's kind of like a mix of short and long-term goals in there, right? I think for students to be taken seriously, the challenge really is, as a young entrepreneur, how can you prove that not only do you have a good idea, but you're capable of running and managing a business at the same time? The idea part is fun and easy. The managing and running a business, is very challenging. I started my business when I was 22 and having to learn HR, IT, legal, accounting. You don't have to be an expert in all of them, but you have to be good enough at juggling all of them simultaneously. And so as an investor looking at young people, I have to ask, can they balance all of that and continue to hit their goals? So I think showing early traction, showing really great movement on your KPIs is one of the best ways to be taken seriously, because you're gonna have all the challenges that any business does, and so showing that you can consistently perform and clearly communicate is really important.
One thing I'll say is that 34, that's kind of all industries. It does depend on the industry. I'll just give, I graduated from Harvard in '97. I remember at my graduation, Conan O'Brien was the speaker, and he said, everyone here is a loser because all the winners already dropped out and started a startup. Because at the time in '97, all the big companies at Microsoft, Oracle, all the billionaires like Bill Gates and Larry Ellison, they had dropped out of Harvard. So there were a lot of startups going on, and in that time in the late '90s, no one would take you seriously unless you were a student, because the new technology, Web 1.0, as we call it now, was very new, and older people had no understanding. Today we have something similar, as I just came from Austin, from Consensus, which is the biggest Web 3.0 conference in the world, and it's going on in Austin. And there, everyone there is younger. There are a lot of students, or at least recent graduates. And in that space, I think I would tell you most people my age have no understanding of blockchain technology, Web 3.0, crypto, all that space. And so someone younger actually has more credibility if they can speak it. But with that said, there are some business basics, which Laura mentioned, which you kind of need to learn to be able to talk, but it depends on what you're trying to sell. I mean, nowadays, Web 1.0, traditional internet, is older school. Everyone that's older knows about it, so that's why it'd be 34, it's average age. But if you're in this cutting edge technologies, where sometimes it's only someone who's younger that understands it, and so to build credibility, it's creating some kind of credential. So if you really know the blockchain space, do something that shows that you've gotten recognized for it, whether it's some kind of competition. You just got to show credentials. That's really what it's about.
Don't care how old you are, funded 15-year-old and funded a 65-year-old, and check sizes up to 50 million. So if you know your stuff, it's good enough. If you're young and you don't know how to run a business, find an old guy. Have them run the business for you while you do what you're doing. I've seen 35 generative AI investments in the last 2.5 weeks. No one's over 23. So we're not gonna fund, no offense to us, the oldest people in the room, we're not funding a 60-year-old doing a generative AI company. As ageist that sounds, I just don't think, it's hard to understand. These people don't know. People don't know what AutoGPT is. I've asked that question, what's AutoGPT? And the 6-year-olds can't answer it. The 22-year-olds are like, I wrote AutoGPT and I have gotten on my, phone. So to me, age is not an issue. I would not use that as a deterrent. I would not use it. Just know your stuff and present well, and we'll fund you.
Awesome, excellent. Moving on, the average time for a company to successfully exit is approximately 8 to 10 years. Considering this for seed and pre-seed investments, or in other words, for the audience that may be not familiar with this, early stage investments, what growth rates are you hoping to see before investing and afterwards?
Using the sort of 34-year-old average, 8 to 10 years, it's very dependent on what you do and what you want to do. If you want, for example, if you want a quick exit, right, and you want to make some money, I would say build a niche generative AI company with 2 people in a garage now, and you can sell it. You can sell it in the next week. And we've seen tons of transactions occurring where people are aggregating in that space. If you're going to build a healthcare senior care business, it's going to take you 20 years. It's just not something that transacts quickly, and you have to get a certain amount of velocity going before you can sell a business like that. So 8 to 10, depending on what sector you're in. Depends on what you're interested in, what you're looking for. Work in that sector depending on what your goals are as for an exit.
Yeah, I was just going to say, I think the math really depends on the individual business type, and I think adding what your individual goals are makes a whole lot of sense.
Well, as a lawyer, one of the structural issues in that is with a venture fund, they actually collect money from other investors called limited partners, and they collect it with a timeline. Usually a venture fund they have to return the money back to the limited partners within 7 to 10 years. So a venture fund is going to be looking, they have that timeline. They have a maturity date that they have to exit out of the company. So what they're looking for is companies that have that kind of exit. But like you said, there are different types of investors. Not everyone needs a venture capital fund. I think as an angel investor, it really depends. I think angel investors usually, we're investing in things that we have a personal interest in. So the timing is less important as far, maybe less important than the success of the business, and an eventual exit can be. But it really is tough to say like what kind of returns, because it really is highly dependent on the industry. Like Amit was saying, like the healthcare stuff does take longer.
Thank you. So, considering the amount of growth that a startup needs in order to be a successful exit for investors, how do you weigh technological and customer trends? So when customer trends, so for me to weigh customer trends, it really there's such a broad field. So like if you're looking at AI, well, there isn't a huge market right now. Everyone just knows there will be a market, and in other areas, there what the kind of customers are looking for, and it can be more targeted. So it really depends. So when you're looking at an investment, one of the things I want to see is, do they have a customer that's targeted, and then what's that market look like? For venture capital, you're looking for $1 billion market at least, because you know that it's really high risk, and so the possibility of losing your money is very high. I think the statistic is, out of every 10 investments, 8 or 9 will go under. So you need that one that's going to succeed in a huge market and make 100 times your money in order to make up for the money you lost from all the others. So when you're looking at customer, we're looking at the market. What's the total market? Is it a big one? Because if it's too small, then if I'm investing money and I'm getting 10% of a company, I want it to be $1 billion company, so I'm getting $100 million, right? As opposed to if it's a $100 million market, well, it's 10 million. And how much are you investing total? If it's 5 million, then I'm only double my money. So you see, that's why the market is really important.
Marketing is my background, so this is the part that I dig really deep into when I'm seeing pitches, and it's amazing to me how many pitches I see where the idea might be fantastic, but they don't really understand the marketing. So I think the trends are hugely important. Knowing whether we're on, the uphill side of a trend or the downhill side of a trend, knowing, the competitive landscape will kind of follow that. If we're on the downhill side, there's usually more competition and more risk defending their ideas. And then the size of the market is something that I see people get wrong all of the time, because they'll talk about just the general size of the healthcare market or something really broad, but I know how to actually build a marketing plan. So when you look at that, it's like, what is the addressable market? How much penetration can you actually expect to have? Do you have an actual go-to-market plan that you've proven out at all? Do you have any kind of traction in that area? So, in terms of the marketing slides, that's what I'm always looking at, is the trends, the technology, and then, if they get the actual marketing plan correct.
I'm gonna be contrarian to the other two folks and saying I don't really care that much about the marketing, the customers. I mean, I would say to you guys, if you're looking at that, is go innovate. If it's right, it'll come. Like, we took one of the first pitches on Uber and we passed. Like, we're morons, right? You know why we passed? Because they said their total addressable market is the entire taxi and travel business, or transportation business, and we were like, unlikely, right? But if you innovate properly, then the market can come if the idea is good. And if it isn't, and the most famous word in all this stuff is pivot, right? You hear that all the time on the Silicon Valley. Pivot. You can pivot into finding a market if the product is good. Now, if the product isn't good, then there's nowhere to go, right? So innovate, and then find a market if you can. And if you can't, then pivot. So, but having said that, as an investor, I mean, we're gonna ask you all these questions, right? What's the total addressable market, defended? I've seen very slick entrepreneurs make it up, and we couldn't figure it out until it was too late, right? So if you're good at it, you get good at it.
Right. I mean, adding off of that. Okay. But I mean, going off of that. If I remember correctly, Uber's total addressable market or market size now is much larger than the entirety of the taxi and transportation market. If I remember correctly.
Yeah, now it is because they've added robo-taxis and they've got stuff from Joby and boats and all the rest of it. But I mean, if someone came to you and said, "We're gonna replace the entire X computer business," you'd be like, "You're a psycho." Like, right? But they did it, right? And that's why it had the exit that it had. But that's what we're looking for, right? We're looking for transformative technologies that are going to have multi-billion-dollar exits. So what Jose was saying is that, and if you guys get a chance and are interested in venture, look up power law theory. I mean, the way venture works is that you have a fund, all your investments go to 0 but 1, which gives you a 10, 20, 50x return. So all you're trying to do is find that one investment, right? And so when people come in with crazy ideas like that, like, you have to think about it. And those entrepreneurs are not always the people who can understand how to put together a good marketing plan or a good, understand the full addressable market. I mean, all of that stuff, there's a human interaction interplay there that you have to figure out. And a lot of people passed on Uber the first time around. A lot of people passed on Airbnb the first time around. A lot of people passed. Like, if you look at who their investors are, they're seasoned super angels who understood taking a bet like that is a moonshot, but if it works, it'll work. And Travis was smart. I mean, that's kind of how it played out. But a lot of firms passed on that the first time around. I can give you 20, 30 examples like that where we've passed and then now they're multi-billion-dollar companies.
Okay.
Can I add something to
Yes,
this? So Amit's kind of big time. I'm just gonna go ahead and say it. He is. He's amazing. Listen to everything he says. I think more seed level, smaller angel investments, like, I don't care if I get an Uber or not. I just want 1 out of my 12 to make it to the next round so that I don't fail, right? And so when you get more into the VC world, when you're further upstream, when you're talking Series A and B and everything, I mean, sure, I would love to say that I have the sophistication to find the Uber in the stack. But I think that there are a lot of businesses that might even follow slightly more traditional models that make worthy investments, and I've seen lots of investors go into. So I don't want to deter people, and especially this is where I put on my mentor hat instead of just the investor hat, is that there are fantastic businesses that get like the crap label of like lifestyle businesses or self-capitalized businesses that are incredibly successful. They may not be VC worthy businesses, but they can be incredibly successful businesses. You can have investors and repay those investors very handsomely without it being a unicorn. So I just want to, as students, I want to say, you don't have to be the 1 out of the 10. You could be one of the 3 others that does very well in life and in business. You just may not have the biggest return, for your VC firm. So,
Yeah, make no mistake. I'm not turning. If I can make $3 or $5 million, I'm not turning it away, right? But it's very important to understand where you are in the cycle of raising your money and who you're raising from, right? So, like, if I had a med tech startup, I would go raise from doctors first, right? They understand what I'm talking about. They know exactly where it fits into the world. If you try to raise med tech dollars early on on a napkin idea, you're not going to get it from VC unless they're specific med tech VCs. It's very hard for them to understand. You need angels who understand what you're doing, and those angels are not looking for that kind of return. That's a very good point. I mean, looking for a 2 to 3x is great.
I wanted you and I heard that. But there's another class of angels
Yeah,
that are
absolutely.
operating at a different level.
Yeah, I wanted to add on to what she said because we talk about entrepreneurship and that's a large label. There's the venture capital industry. As an attorney, I do a lot of venture capital work. Again, those are larger numbers. As an angel investor, it's a lot smaller checks. And then I also represent just small businesses, and all of them can make money. They're just different. The basic advice is venture capital money is the most expensive. It's actually the worst way to go to raise money, but it's usually the only way to go for certain ideas, and that's the reason why. Because there are like these AI companies. None of them are making money right now. So a bank is not going to give them any money. It's hard to raise money from any other source than from a venture capitalist. But venture capitalists will take the most out of you as well. So it's not, if you have an idea that can make money without having to go to venture capital, that's actually the best way to go. But if you want to really, that's why there's a lot of different roads you can take, and venture capital isn't the only way. You know, like for example, one of the worst businesses everyone always says is the restaurant business, right? It's the worst one. It's the one that's the highest failure rate. But there's a lot of rich restaurateurs out there. So it doesn't mean that you can't start a new restaurant today and have something that's really successful. There's different ways to go about it, and all of it is entrepreneurship. But really, it's kind of what we're focusing on the venture capital route, because that's kind of, I mean, at least in the law firm world, in the lawyer world, and when I was in law school, like that's the most like sexy route to go if as a lawyer. Like you want to be a venture capital lawyer. But and as an entrepreneur, maybe there's some cachet to it. But it's not. You can sometimes make more money doing something else. But I think that's an important point to bring up.
Silicon Valley Bank will give you money.
Had to go there.
All right. Well, so far we've talked a lot about what investors consider when looking at investment, as well as a bit of the entrepreneur side, which you're raising money from which sources and whatever. But let's sort of move past that. Let's say after sort of both parties agree to sort of get to the negotiating table, and they talk about the term sheet, right? What are the most common friction points you guys see between investors and entrepreneurs, and why do you think those exist?
Yeah, I mean, right now, valuation. That's a huge one. I mean, it's right now is a tough time to raise money. It's not like last year or beginning of last year, valuations were super high. Now it's the opposite, and the pendulum swung the other way. So, like right now, I'm in the middle of 3 different term sheet negotiations, and it's all about they're all down rounds. So, and down round means that they had raised money previously, and this time they're raising money with a lower valuation than previously. So that's really what it's all. That's the biggest friction point I'm seeing right now.
So I think what angels in my position are are generally looking for is, what the valuation is hugely important, and the valuations vary tremendously from coast to coast. The Angel Capital Association is a neat organization up in Austin that does a bunch of research and gathers data from across different angel associations. They gave a presentation at Alamo Angels that was just incredible, where they shared all this data. You can download this free report from their website. You're gonna have to just provide your email. It's definitely worth looking at as you're pursuing, entrepreneurship, because it gives all kinds of data on the ages of investors, the different types of industry, how much money is invested. There's some geography mixed in with that, and it talks about the different types of notes that you might have. I think how much equity you're going to wind up with. Can you get a preferred, the opportunity to have preferred options on the next round? How much are you going to be diluted? Those are all like pretty basic. So I've only been doing this long enough to see but several of the businesses starting to fail that are in my portfolio. So that's normal. And so with some of them, trying to see, do we get paid back anything? What are the protections that you have in place? And we're kind of gambling. You kind of assume that the ones that go away, you're not going to see anything. But those are negotiation points as well, as you might be able to recover some of your investment in the ones that are going to fail, as opposed to losing all of it. And then for the ones that are going to succeed, what are the preferred terms on the next round? And things like that are always interesting, because for some of we have made many additional rounds of investment in businesses in our portfolio that are succeeding and are moving on to the next round.
I forgot to add one thing. It's important for you to know. When I say valuation, what that really means, because I forgot, this is what I always tell founders when I represent them, it really means percent ownership. So when you're negotiating the valuation, you're negotiating how much percent that you're gonna own the company. So if it's a $1 million investment and I'm saying it's worth 10 million, what I'm really saying is I wanna buy 10% of your company. And that's what I always teach my founders, which is valuation this is kind of like a gentleman's way to kind of negotiate, because what an investor really, what a VC is really concerned about is percent ownership. A lot of times they have a requirement that they have to own a certain percent of the company. But if I'm negotiating, I want 20%, and you're only willing to give up 10%, that's like just a door knuckle brawl. I mean, you're just negotiating 20, 10, 11, 19. it's hard to negotiate, and and someone's gonna win, someone's gonna lose. If you negotiate based on valuation, that's a nicer way to do the same thing, because I'm saying it's worth 10 million. I'm gonna give you a lot of reasons why it's worth 10 million. You'll give me other reasons why it's worth something else. In reality, you're just negotiating the percent ownership of the company, and that's what. And an investor knows that, and that's what they're thinking. They're thinking only the percent ownership, but they're using the valuation in order to do that. And that's why it's the most negotiated provision, because it's giving up the percent of the company, and that's why it is super important.
I guess I would say it depends on what phase of investment. Like, I mean, we don't actually have any friction. I have to say, when we have term sheets, we pretty much give in to our entrepreneurs for the most part, because the thought on the venture side, right? We're talking very later sort of investment, not the pre-seed or the angel stuff. Our assumption is your company is going to be a multi-billion-dollar company, so a couple percentage points of actually doesn't make that much of a difference to us. We're going to return or 10x our fund off of your investment, so we're not going to fight you on the valuation. Very early on the pre-seed stuff, for most of the investments, I think for the entrepreneurs that we deal with that are smart about it, you come with terms, and for most angel investors, is take them or leave them. I mean, it's not that much negotiation if you have a concept that's good, that is heated, and people want to participate, because the chances are you're going to find investors. Now, if you have an idea that you're struggling to raise money, and the idea is not great or whatever, then you're going to negotiate a lot and probably give up a lot more of your company. Where we do have a lot of friction is once we've made the investment and something happens. And I'll give you an example. We have a company, fascinating, it's two guys from Stanford. It's called First Resonance. They worked at SpaceX. When SpaceX needs to build a component, you can't go to McDonnell Douglas and buy it, right? It takes 3 years, FAA, FCC, whatever. It takes $100,000. So SpaceX just creates the products in-house themselves. They have the full tooling, full CNC, full machining. These guys build a factory OS. And that factory OS does everything from procurement down to production, QI, QA, gets it through the space program, everything that they need. They went on the road and started their own company called First Resonance, and they're selling the factory OS. And their first customer is a company called Joby Aviation that has these autonomous taxis. Well, super hot company. We were the seed investor. We put $1 million into them at a $10 million valuation. They have one customer, Joby Aviation. They have $500,000 in trailing revenue. They went to raise their next round, and Tiger gave them $150 million valuation, right? It was 300x trailing revenue. And we came to them and said, don't take the money. I mean, you're dumb to take the money, because you know what's going to happen is you're not going to grow into that revenue. Like, you're not going to have 50 million in revenue by next year. It's impossible. So what's going to happen is you're going to need more money in another round, and you're going to take a down round. And you don't want a down round in this business. You want to keep growing because your customers come very slowly. But the two founders, 20 and 21, suddenly realized that their 50% of the company now is worth $75 million. They thought they were rich, right? They started to buy Lambos and crypto, and off they went. But they don't have the money, because now they've taken a down round at a $7 million valuation. So that's when the friction occurs, is later on, once we were already in the investment. We don't want to have friction at the time of a term sheet, because it's like a marriage. We're getting into bed with you. We're going to be with you for 10 years. We're trying to help you grow a company. So we're not going to try to nickel and dime you up front, for the most part, on the venture side. Angel a little different.
Also, just the legal thing to add, and one reason why the down round is bad is that most of the time you will have, an investor will have an anti-dilution provision. So when there's a down round, that gets triggered, and that means that that previous investor will then get more of the company. And so you as the founder start getting less of the company, and so you get dramatically, start getting less and less of the company. There was a famous case in the late 90s where this company had a couple down rounds, and the founders went from owning 60% of the company to owning like 0.6%. And they were fighting because there was this one provision they thought shouldn't apply, and they should have had 5% of the company. Normally not a big deal because they had these down rounds because they were doing horribly, but then they turned around the last minute and got sold for like $6 billion. And thus the difference between 0.5 and 5% became material and worth suing over. But that's how dramatically anti-dilution provisions can take you down, and that's why you don't want to have a down round, because it's a way for the previous investor to claw back and get more percentage of the company.
Thank you. So, going off of Steve, like you're all experienced about the entrepreneur investor sides. Yeah. When investing, how do you think about control of the startup and coachability, or is it kind of more leaving the founder to work on their idea with telling on how you guys can do it.
Yeah, I mean, the human element, people is the most important thing. You can have a good idea, but if someone isn't good, then it's not gonna work out. So, the people that get funded because they have like an idea in a napkin, a lot of times it's because they have a good reputation already. It's sometimes they're serial entrepreneurs, they've already done projects before that have been successful, so people trust them. So the most important element is the people and making sure that, okay, these are people that can execute. I mean, I was part of I had a client, and I actually invested in them, and they had an idea that's really good. It had to do with prescriptions, because I'm a healthcare lawyer as well, and one of my pet peeves is every single problem that we have in U.S. healthcare, there's a law that causes it. So this company, what they were doing is the ability to go on have an app, you had a prescription, and then you could see how much that prescription would be at all your local pharmacies, and you would see the pricing at all the different pharmacies. And the issue they had is that it's illegal to electronically move your prescription from one place to another. Under the law in Texas and in most states, you can only you can e-prescribe to one pharmacy, but you cannot move it from one pharmacy to another without doing it by phone or fax. You can't do it through the internet. And at the same time, there's a requirement to e-prescribe in most states now, so you have to automatically send it to a pharmacy. So you are unable to shop for your prescription pricing. And what people don't know is that prescription pricing can vary wildly. So the same thing and it can be wildly, like one Walmart location might be $10 for something, at another Walmart location could be 50 cents for the same prescription, same everything else. And so there's wild differentiation between pharmacies, but you don't know, the only way to know is to shop around. And the problem is shopping around is really difficult, and you can't really do it online. Well, this company figured out a way to do it, but what happened was, it's a great idea, right? How many people would like that, right? Because people know about GoodRx. GoodRx is kind of a scam, this is like even better than GoodRx. And what happened was the CEO, who owned most of the company, he ended up having some mental health issue and just dropped in for 3 months, just refused to respond to any phone calls, emails, anything for the company. And he had investors and had everything, but it's like he just disappeared, and all the passwords were in his name. He had all the passwords, everything, and for 3 months the company just fell apart, just completely fell apart. He came back, and the investors were still willing to kind of continue with the company, but they were like, "But you can't be the CEO anymore," and he refused, and he had a majority of the shares. So the investors all walked out because they're like, they're not going to back this guy, and it's because he proved to be unreliable. And the other thing I want to add, which may be controversial, but for every business owner that I know, they have issues hiring Gen Z. So Gen Z does not have a good reputation. So when I talk about the human element, that's one thing that you have to kind of show. Dependability is like a real big issue, and that's one thing you have to show if you're going to be, if you're going to be trusted. That's a big thing. It's being trustworthy.
I almost forgot the question because I'm stuck on the whole is this being recorded or streamed? Yeah. Okay. Then I'm gonna monitor what I say. I love my Gen Z employees. I just gonna say no. I do. It's some of the other ones I have an issue with. Okay. Can you repeat the question?
Yes, yeah. Your all experience on both the entrepreneur and investor side, and when investing, how you think about control the startup? Is it more important coachability, or you get more like the founder, work on your own and you can call upon you as needed?
Right. So at the stage that I'm investing, there's no expectation of any form of control. None at all whatsoever. I'm not asking for a large enough percentage. It's not coming with strings attached other than just the contract. That being said, I'm meeting a lot of them through mentorship, through relationships that are kind of a coaching relationship to begin. So I love that I have ongoing relationships with a lot of them where they'll consult me about marketing, my husband about finance or operations or contract negotiations because he's got more experience with mergers and acquisitions. So we love businesses that do stay in touch with us and that we can be involved in because we're entrepreneurs. So it's fun for us, and that's part of why we're doing this, right? But I will say, when I first started, it was more about that coaching and more about that relationship. And now, as we've become, just more interested in investing more, we're even less involved. So for what that's worth, I think investors come in all different shapes.
Yeah, same. On the earlier side, very involved, try to help as much as we can. There's a lot of just operational things that if you're a first-time founder, you don't know how to do some of the stuff Jose does, or you don't know how to do it, something. First time you gotta get K1s out to your investors if you've never done that. So those operational things, it's a check mark now. They're very easy to do. Later stage, we're really involved, and a lot of it is helping companies scale, right? So making introductions. So like I do healthcare investing. We have Stanford, Cleveland Clinic, Northwell Health, Dignity Health are all LPs in our fund. They've invested money in our fund, so we connect our healthcare companies with these large hospital organizations, and they're now, they pick up a client that has 50,000, 100,000 doctors, one swoop. So later on, we're very, very involved. I would say early on, unless you come to us and ask for help, it's not like I'm calling, my 0.1% ownership in your business every day. But when I have 25% ownership in your business, I'm all over you.
At bigger stakes.
At bigger stakes, yeah.
So something probably also that I learned about the angel group in Austin that they mentioned at this presentation is that if they give a large enough amount, they will sometimes ask for a board seat. That'll be a requirement. So if the group pulls together, and I don't remember exactly what the dollar threshold was for that, but that could be something that would also be an expectation in terms of control. But that's so that they can help also. That's not so that they can control, it's so that they can be of service.
Yeah, there's no benefit to being on the board, I've learned, right? So like I have to buy D&O and G&O insurance and all this stuff. Like there's really no benefit to me, except to help the company. So it's not like people are clamoring to be on boards. You get exposure and liability more than, and a bunch of board meetings that you have to go to. So if they're there, they're trying to help you.
All right. So moving on to the last question before we open it up to the floor. The world isn't exactly in the best place right now, the best state. The Russia-Ukraine war, you have the collapse of SVB, and then you have some of the recession talk. I mean, is now still the right time to build? And if so, what are some opportunities?
It's always the time to build. I thought the same. I've thought the same thing many times. Everyone's invented everything, and then I get some pitch, or I'm like, holy! Like, I had a pitch today on a guy has a company that has an atomic foundry. I don't even know what that is, but we start looking at it. This guy can take atoms and create stuff, and so there's a huge opportunity in the material science space. They can basically get friction down to almost negligible. So an electric car, batteries can last almost like they have. In a small model, they can have an electric car run for 7,000 miles because it's frictionless motors at an atomic level. So there's always time to innovate. I mean, would I, open a restaurant in a recession? Probably not. But there's always things that you can do if you're interested and find things to do. So yeah, always innovate. There's always someone who's funny stuff. Like the generative AI stuff right now is all funded and at crazy valuations, right? It wasn't there a month ago. If you think about this, right? ChatGPT came out March 6th. AutoGPT came out last week. Like the pace of innovation here in this sector is hours to days to weeks. Like we're seeing a doubling time. And we've never seen that in any other industry before. So if you some guy, I'm going to San Diego tomorrow on Southwest. Some guy wrote me a bot in ChatGPT that checked in for me automatically, right? I mean, it took them literally 30 seconds. He showed me how to do it in Python. So the pace of innovation is so fast that just get involved in things that are moving rapidly if you're scared of being antiquated or a dinosaur.
Yeah, I think that if you look at, I was going to say the same, just any time is a good time. If you look at what people are investing in, so even though you hear these large statements like, investment money's being pulled back, things are slowing down, stuff like that. There are always investors that are looking to invest, and there's always companies that are leading the pack. So just because overall things may have slowed down, it doesn't mean that there isn't still tons of opportunity. You might be getting feedback on how good your idea is, or how hot the investment market is, but I think that if you've got a great idea and if you're really connecting with investors, that there's always opportunity. I don't know any investors personally that are doing the angel side that just completely stopped. Everybody that I know said, finally, we can actually get into the market a little bit more, because there was so much investment happening for a while, but it was hard as an angel investor to get in on some of the deals. It was just tricky, and so we kind of found that things tightening up a little bit made it more exciting and gave more opportunities to some of us.
Yeah, I think one thing to separate is building a business and investment. So right now, it's a bad time for most investments. I mean, some areas are hot, some areas are not, and so investment's slowing down. But building a business, I echo what they say. Anytime is a good time. For example, in 2002 was the .com crash, and so I began being a lawyer in 2000. I was working for a law firm that in 2000 they had done. There were 300 IPOs in the country, and they had done 100 of them. So it was like all this activity. 2002, there was a total of, I think there was 5 IPOs in the whole country. So the whole market went really way down in those 2 years. But you can name, there's like Facebook, for example, was founded during this time. There's a lot of companies that get founded in times of stress. There's actually also statistics showing that there's more businesses that are formed in times of recession, because people lose their job and they decide, you know what, instead of finding another corporate job, I'm going to start a business. I'm going to be my own boss. So I think, in times of uncertainty, investment will slow down. That's true. But actually building a business, I think more businesses are formed during this time, because more people think, you know what, I'm not going to, well, it's harder to find a corporate job, so I'm going to start my own thing.
So much. All right. Now, with that said, let's open it up to the floor.
What are some traits in founders and entrepreneurs that you as investors would be looking for in identifying good potential ventures to invest into?
For me, it's reliability and adaptability. Those are kind of 2 things. It's someone that's going to be a steward for the money that you give, and so someone that you can kind of rely on it. And then the adaptability part is, you mentioned pivoting is kind of the big term, and you have to adapt to the situation, and not just adapting to like the market, but it's just adapting personally to the lifestyle of an entrepreneur, because it is different than the lifestyle of any other kind of lifestyle, because your business is almost like your baby. It should be like your baby, and you should be thinking about it all the time. So you kind of have to adapt to that kind of lifestyle and to what's going on with your company.
I like transparency and communication. So some of the companies that I mentored really early on have these amazing updates that they send out on a really regular basis, and they're just really transparent with their KPIs. They're really transparent when things are going horribly. They'll ask for help when they need it. They don't mind putting that out there, and seeing them over years now overcome their hurdles, get people that respond and offer help, and that, so when you're saying, what do you look for early on? Yeah, I'm telling you, I've seen this over a period of years, right? Working with some of these companies that I've now identified. I like people that communicate really well and that are transparent and vulnerable and share the obstacles that they've faced and how they've pivoted, how they've overcome them. I really hate the word pivot, but there's no other word, I guess. I really like to see that grit and tenacity, because that's what's going to play out over the long term, or at least get to the next stage, whether that person's there at the end or not. And so that communication, I think, is just really important.
I look for 3 things. One, I want you to be smart, right? If you're starting a next generation sequencing DNA company, you better know what the 4 base pairs are in a chromosome. If you don't, then I'm not investing in you. So 1 is, do you know what you're talking about? 2, I like to see passion. I want to see that you love what you're doing, and that this keeps you up at night. You love this. And then 3, this is kind of a me move, but I call all the entrepreneurs when we're working on a term sheet Friday at 10 o'clock. And I want to see if they answer the phone. And if they don't answer the phone, then I have a tough time investing, because I answer the phone no matter what time you call me. And I want to see that they're really engaged in their business, and that this is their primary thing. I don't, it's okay if you answer the phone and you're drunk, it's okay, but I want you to answer the phone and be able to talk intelligently about your company and that you're passionate about it. So answer the phone when your investors call you.
Have you had that happen to you, where someone picks up and they're drunk?
Oh, yeah. It was Coachella, right, 2 weeks ago, like, they were at Coachella, so.
Yeah, so what are the pros and cons of LPs versus the family office? You guys heard that before?
So for us, so venture size, right? Usually our LPs write bigger checks and are like $30-50 million range, and then are very institutional. So in an institution, like for example, the state of Hawaii is one of our investors. They put money in our fund. They have a manager who's responsible for that money. That manager is an employee, right? That they're an investment professional, but they're on a salary. It doesn't matter. I mean, they want everything to do well, but if it doesn't, then they go to another fund, right? In a family office, the people running the family office, for the most part, are intricately linked with the family, with whoever's money that is, the individual billionaire or million or whatever. So there's a different relationship, and it's a lot harder to deal with family offices than it is an investment professional at a state level or whatever institutional level. So our preference are institutional investors.
I mean, when you say, I guess you're talking about investors in a venture capital fund.
Yeah.
Yeah. I mean, there's, so I don't run a fund, but I do have a lot of fund clients, and different funds have different preferences. The institutional route, there's bigger money there. So if you want to raise a large fund, you need to have institutional investors. So that's kind of no way about it. That's what you're going to have. But they usually have, everyone wants institutional investors, so there's a process there. Family offices, a lot more. Family offices are all different. They're like individuals, so they have different styles, and so sometimes they'll match your style. But sometimes they're a lot more casual than an institution can be. I mean, some aren't. Some family offices are very process oriented. Some are not. So I think, if you're a venture fund, I mean, really, the goal for the funds as they grow, because I've had a couple of clients who've seen them grow from fund to fund, and they start off where it's mostly individual investors and maybe some family offices, and then eventually they get to the institutions. Because if you want to grow your fund, you want $1 billion fund, you need big dollars, and that's going to come from the big institutions.
There are perks though, like the Chanel family is an LP in our fund, and my 9-year-old has a Chanel bag. It's pretty good. So it depends on who your LP, who your family office funds are.
Just choose well.
Yeah, I'm trying to pick those. But they gave both my kids and my wife Chanel bags, so it can be good.
So this is more of a personal question. Sorry. There we go. This is much better. This is more of a personal question, but I'm curious. Why are you guys in the investing space? Do you like
Money.
do you like gambling? Do you like mentoring? Do you like seeing businesses grow? Is there any emotional attachment? Yeah.
I mean, first off, it's part of my livelihood as an attorney. But the investing side, I got into investing. I mean, I'm not putting in big dollars. I'm not putting millions of dollars anywhere close. But so when I invest, it's really projects that I believe in. So or something that I find really interesting, and I think will make money. So the money part it's got to be there. But sometimes I see things that make money, but you know what? I'm not going to throw money there. But it's something I have like a personal interest in. So for me, healthcare ideas I like. Or I invested in one company. Actually, my phone service is through a company that stops SIM swapping. And a lot of people aren't aware that it's possible to take all the information. To get your phone number switched to another phone, and all that the person needs to know is your phone number to do it. And that's a common practice to just kind of get your passwords, you know, it's kind of a cybersecurity issue. And with the big companies, they don't protect you for it. I mean, it's just really easy to do it. So I had this one startup that they formed their own phone service. They're really kind of a reseller. That they do is they protect you against SIM swapping. And I thought, wow, that's really interesting. Because whenever you see that those celebrities have their photos taken, it's because they're SIM swapped. And it happens. And there's actually videos where you see somebody who says, give me your phone number, and then within 5 minutes, you call and it's on their phone, not yours. And so it's a big problem. And I didn't know about it before I met this startup. And so that was one that I invested in because I thought it was really interesting and something that needed more attention.
So definitely the reason I got into it is because my husband and I are entrepreneurs, and we both started our businesses in our early 20s. We love entrepreneurship. We love working with other entrepreneurs. We love to see different business models and different business plans and think through ideas. And so this scratches an itch in terms of us being able to be engaged with a lot of different types of businesses without having to actually run them day to day, because that part's hard, right? So it is immensely fun and rewarding to be involved with a bunch of different businesses, and that's definitely how we got into it before we really had any significant amount of money to invest. To be honest, the first investments that we made, if you looked at how much we invested compared to our overall net worth, it might have been fairly foolish. Because angel investing is incredibly risky, right? And you need to have a large enough portfolio to have 10 or 11 fail and the one succeed. And so dabbling in it is probably not the wisest idea from a financial standpoint. So I don't think, yes, we wanted to make money, but I think we did it because we liked the people and we liked the ideas and we believed in it and we wanted to work with these companies. And that definitely kept us engaged in it. Now that we have more money to invest, if you look at it just from what is the typical investor profile of angel investors, it runs the gamut. For early stage stuff, you'll see the friends and family rounds are just people that make bad financial decisions and decide to give somebody $25,000 or $50,000. That happens all day, every day, right? And they might not be the best financial decision for them overall, in all honesty. But once you have enough of a base of wealth established, and you can invest in either funds or those at least 12 companies over a short period of time, your returns on angel investing should be significantly higher than anything you can do in real estate or in the stock market. So it's actually part of a good investor's portfolio to have a certain percentage in alternative investments is what this falls under, and you're doing it for the higher returns.
Yeah, I think this very personal journey, right? For me, I had a lot of passion for being a doctor. I wanted to help people, thought this was awesome, intersection of tech and all that sort of stuff, and then got into the healthcare system and realized, God, this thing sucks. The healthcare system, I would say, is broken, right? So let me try to fix it. So I became an entrepreneur, went down that path. And that was super hard, and this sucks. I was like, well, the next step was that I became an investor, and then, let me fix all this other stuff. So it's just sort of that personal journey along the way of trying to fix stuff as you experience it and understand which one of these things that you can affect change. And that was probably somewhere where I thought that was the biggest impact was, in investing was the place where you could spread a lot of money out to a lot of companies and try to affect a lot of change, as opposed to being very singular. As a doctor, you treat one patient. As a startup, you can do 100 people. And investor, you can do sort of population level stuff.
Yeah, I think that's the soul of entrepreneurship for me is fixing things. You see a problem in one patient.
Kate, you want to ask your question?
We have time for one more question.
It got answered.
It did.
What do you generally want to see most from companies that want to join your portfolios?
Yeah, it's pretty broad question, right?
Yeah, I'm curious because I figure it's one of those things that's going to be a very different thing for each of you. This is a very personal kind of thing.
Yeah, I think some of it is it's stage based, right? Is important, right? So like Laura was saying, angel investing, you're making an investment. You're not looking for. I mean, it'd be great to get 100x return, but that's not necessarily what you're trying to do, right? Like a 2, 3, 4, 5x is great because you're making a whole bunch of angel investments. They're smaller check sizes, lots of companies. You're hoping they all kind of go 2, 3, 4, 5. On the later stage stuff, or if you're at venture, not necessarily later stage, but Series A, looking for a huge exit, like we're trying to really evaluate, is this a big idea and can you execute on it, right? Those are the two big things that that we're gonna look for. So we spend a ton of time and money on doing a background understanding of your idea, and talk to consultants and talk to everybody under the sun. Is this idea good? And then make an assessment from our experience. Can you execute on that idea?
So to start out, we were really investing in the people that we really liked. We really believed in them. We thought they were completely transparent, not full of shit. I can say that. We just really believed that they had a good idea and they were good people, and we believed that they would succeed in executing to the next level. I would say now that we have more to invest, and now that we're becoming, more liberal with what we're investing in, trying to invest in more companies, it's become a much more, and I used to have a clear understanding of the business, and now it's a little bit more of a grab bag, to be quite honest. Sometimes I'll think it's following a trend, or I want to invest in a female founder, because I also have to believe in her and the idea, of course. But I've become a lot more liberal in my acceptance of the range of different types of businesses, I think, as I've become more experienced, not as pigeonholed in things that I know.
So your question made me think about the investments I've made and why I did it. Mostly, I think it's something that was just I found interesting. Sometimes it's because I already had an interest. Sometimes it's just something that was just I couldn't believe it. There's a local company, Hera Biotech. I did an investment with them. They have a kind of a solution for identifying endometriosis, which I'd never heard of before, and it's a disease that happens only to women, and usually it takes 8 years to diagnose, and they found a way to diagnose it immediately, and I didn't even know it existed, and so it was interesting for me, and I liked the founder, and the founder she's great. So actually I was mentoring her through this was another program, and I actually had to pull from being a mentor in order to invest in her in the company. I didn't have an interest in endometriosis before. It was really just the founder and the idea, and I thought this is something that's just good for society. At the same time, there's another investment I made that it was purely because it was a client, and they were getting investments from Sequoia, Benchmark, all these top VCs out of San Francisco, and this is the truth. This is one thing to realize with investing. There's a herd mentality. I know that there's herd mentality. There's a lot of sheep, and I found myself being one. I was like, all these other people are investing in. I need to put some money in this too. And because they're my client and I was doing the deal, I could use. I just asked my client. I was like, hey, can I just put a little bit of my money in this too? And they're like, yeah, sure. But that one was purely I didn't understand what he was doing, but there's all these other cool people that do, so I might as well. So, and I think that happens a lot. It happens a lot.
Doing endometriosis for men.
Yes.
It's more in the brain, though. Can I ask a quick question? How much should our entrepreneurs shop for which investor, fund, or person should they go to? Because a lot of you've been talking about what kind of your particular interests and what kind of spurs your imagination. Should they get to know you better? How do they go about finding who's a right fit for them?
I want to jump on that. So if you have investors that are just clamoring, by all means, interview the investors and pick the ones that are the best fit. But I think you'll find it's challenging to find investors, and that you need to court a lot of investors and communicate with them over long periods of time before you really get traction with them. So I do think that, yes, there's a difference. And again, at really early stages, so probably what we're looking at from a lot of the student startups is very early stage investment. They're not expecting control. You might get great mentors and great advisors out of it. You might find people with great connections. So looking for somebody that gives you smart money and can really assist you in your business, I think would be great. But I hope that you're all in the position that you have investors fighting over you and you can pick or choose. I'm not sure that will be the case. So just to level set expectations.
Yeah, I mean, we tell all the entrepreneurs, remember, take all the money you can get from whomever you can get it from. I mean, canvass the homeless if you have to. Just get wherever you can get money, I would take it. We, I will say, I think seek counsel before you start raising money from. There are non-diluted sources, right? You can get grants. There's lots of places to get money. This is a great place to be in the world if you have anything that has any military bent, and you can make anything sound military. That's what I've learned. And they have a ton of money that they want to give you for free. So there's a ton of places where you can get non-diluted capital, SBIR, STTR, military, Velocity Texas, Bear Bio, AIM. I mean, it goes on and on and on. If you can learn how to master that, you can get a ton of money for free. And there's lots of companies in town that have done that really well. And then go to sources that are going to take your equity.
And I think don't discount the fact that you may be able to run your business without raising much money at all. This whole industry is created by investors who are frothy for that 1 out of 12, and they will burn you down. They don't care. They're going to shove past the 9 to get, to the one that's going to be successful. And so I think that the world has kind of created this entrepreneurship frenzy. The investors want to see as many ideas and as many entrepreneurs as possible, but you can run a really solid business, make a ton of money. And I just want to highlight, my husband went to Trinity. He wrote his business plan in the entrepreneurship class the first year that Billy and Steve taught it here at Trinity. And he just had a huge exit from his business a couple years ago. When they first started the business, there was no intention of, or at least I don't believe that they were thinking, oh, we're going to exit in 3 years or something like that. And so, they ran a really successful business, profitable, made them happy, brought everyone joy for, I think it was almost 20 years before they sold it. So just keeping in mind that that bell curve, is a big one. But if you're not seeking, they didn't raise outside investment, so they could run it as long as they needed to, and they didn't raise money until the very end. They sold a third of their business first to a company with the intention of then having a full exit. So they didn't bring in those big investors until they were already really big. So there are different ways to go about growing your business. It's worth exploring.
Yeah, to your question, is you got to talk to a lot of investors, and you're going to get a lot of rejection. The example of Uber got a lot of rejection before they got investment. Ring Doorbell, they were actually on Shark Tank and they didn't get any investment, and they had a great exit with Amazon. So you're going to get a lot of rejection. So you have to talk to a lot of investors. If you're lucky enough to get investors interested in you, you need to get as many investors interested as possible. Before we talk about the term sheet, the only way you can really negotiate is if you have more than 1 people at the table. If you only have 1 investor that's interested, it's really hard to negotiate. If you have more people interested, then that's when you can negotiate and get the best deal that you can. And the only way to do that is by talking to as many investors as possible. And it can end up being hundreds of people. So that's why I like to compare it to dating. At least my dating.
Thank you so much to Amit, Laura, and Jose for sharing your insights with us. I'd also like to thank everyone in the audience for joining us today. Please join outside to continue networking and enjoy small bites.